A man in North Carolina rolled over his $204,401 with a 12-minute phone call to his bank. Simple, he was told. Happens all the time. 6 weeks later, a check showed up in his mailbox for $163,000, not the full amount. He had no idea he had just triggered a tax bill that would cost him $59,000 more than his former coworker who did the exact same thing, the right way. Here is the 12-word mistake that made all the difference.
Let's dive right into this. I want you to picture a very specific Thursday afternoon. We're not in a tax office and we're not in a courtroom. We're just at a dining room table in a townhouse in Raleigh, North Carolina. The man sitting there with his laptop and a stack of mail is Vincent. He's 58 years old, a careful project engineer who just spent 22 years at a mid-sized manufacturing company, right up until his position was eliminated in a corporate restructuring. In this explainer, we're going to calmly walk through the exact mechanics of a financial nightmare that is unfolding right there at his dining room table. Vincent is staring at an envelope from his tax preparer. His federal income tax liability for the year is sitting at exactly $68,400. Now, what's really devastating about this number is that Vincent didn't make some wild, careless financial gamble. Not at all. He's the kind of guy who reads the owner's manual cover to cover and files his taxes early in February. This massive tax bill was actually triggered by a simple, seemingly innocent paperwork procedure. The whole story starts with this number right here, $204,000. You see, when Vincent was laid off, he got a standard HR letter explaining he had 60 days to decide what to do with his 401k balance, which totaled $204,000. Wanting to be responsible, he made a quick 12-minute phone call to a pleasant representative at his bank of 19 years. She told him, sure, he could simply move the money into an IRA right there at the bank. He filled out the form that very same day. 6 weeks later, a check arrived in Vincent's mailbox. But the math didn't add up. Let's look at the real numbers. The original balance was $204,000, but the check he received was only for $163,200. The difference? $40,800 evaporated immediately. It was withheld by the plan administrator as a mandatory 20% federal income tax deposit. Vincent, being a reasonable guy, just assumed this meant the tax part of the process was already handled for him. So he took that check for $163,200 and deposited it straight into his standard bank checking account, assuming the whole process was complete. Because he did that, he now owes an additional $27,600 on top of the $40,800 that was already withheld. And he has just 60 days to pay it. The clock is officially ticking. So we really need to understand the mechanics of exactly why this happened. What Vincent unwittingly initiated during that short 12-minute phone call was something called an indirect rollover. In an indirect rollover, the plan administrator distributes the retirement money directly to you. When they do this, the IRS strictly mandates that they withhold 20% for federal taxes right off the top, exactly at the time the check is issued. You receive the remaining 80%, and then a very strict, unforgiving countdown clock begins. That countdown clock is known as the 60-day rule. Under this rule, Vincent had exactly 60 calendar days to deposit the full original amount of $204,000 into a qualifying IRA. Think about what that means. He had to not only deposit the check he actually received, but he also had to come up with the missing $40,800 right out of his own pocket. He'd essentially have to loan himself the money just to pay back a tax he never even intended to trigger. Because he didn't do this and just put the money in a regular checking account, the 60-day window closed. The IRS permanently classified his entire retirement balance as ordinary taxable income. The massive warning sign was sitting right there in the mail the whole time. The check Vincent received was made payable directly to him, Vincent R. Hargrove. A check made payable to you personally is the absolute clearest indicator that an indirect rollover has been initiated rather than a direct one. Vincent just didn't know to look for this signal, and frankly, nobody at the bank told him to look for it either. Now let's contrast that trap with the exact procedure Vincent actually needed to use, a direct rollover. A direct rollover is a trustee-to-trustee transfer. It simply means the money moves directly from the former 401k plan administrator straight to the receiving IRA custodian. From a tax perspective, this transfer is completely invisible to the IRS. It creates zero taxable income and absolutely zero mandatory withholding. The money never even passes through your hands. If a physical check is involved at all in a direct rollover, the text on that check will look something like this: payable to the IRA custodian for the benefit of, or FBO, Vincent. It is never ever made payable to you personally.
Bypassing your hands entirely is exactly what protects your wealth. That is exactly what you want to see on any transfer paperwork.
To truly understand the gravity of this situation, let's look at a tale of two colleagues. Let's compare Vincent with his former colleague, David. David went through the exact same corporate restructuring and left the exact same company 3 months earlier, and he had the exact same 401k balance of $204,000. But instead of calling his bank directly, David made his first call to a financial planner. Because of that one decision, David executed a direct rollover while Vincent ended up stuck with an indirect rollover.
And here is the resulting tax reality for both men. David's federal tax liability for the year, based on his other income sources, was a very standard $9,400. Vincent's federal tax liability, because his entire retirement balance was suddenly classified as income, is a staggering $68,400.
That is a $59,000 difference in tax liability. Just let that sink in. Both men left the exact same company in the exact same year with the exact same balances. The procedure looks nearly identical from the outside, but this massive destruction of wealth was caused entirely by using the wrong 12 words during a paperwork transfer. A transfer that, by the way, takes zero additional time or effort to execute correctly.
Now, there is a very narrow window for rescue here, and I want to calmly walk through it. The IRS actually has a specific provision called Revenue Procedure 2016-47. It allows a taxpayer to self-certify for a waiver of that strict 60-day rollover requirement. But this is only allowed under highly specific circumstances, such as when the financial institution makes a verifiable error in the rollover process, or if the funds were deposited into an account that the taxpayer reasonably believed was a qualifying retirement account.
If Vincent acts immediately on this Thursday afternoon, there are strict mechanical steps he must execute. First, he has to document the bank error, proving they didn't explain the indirect rollover or get his informed consent. Second, he must open a new IRA. Third, he has to deposit the full $204,000, which means using his own funds to cover that withheld $40,800. And finally, he must file the self-certification and an amended 2025 tax return to remove the distribution from his taxable income. That is the only way to potentially eliminate that extra $27,600 he currently owes.
The scary part is, Vincent's situation is just one version of this trap. There are actually 4 very common scenarios where this identical procedural error destroys wealth. It happens all the time during job transitions when a new employer's plan won't accept immediate rollovers. It happens when workers retire at 59.5 and take a partial distribution, completely unaware that it triggers a full tax event. It happens frequently to spouses who inherit a 401k and innocently deposit a check made out to them personally. And it happens during company bankruptcies when workers mistakenly assume a payout check is just a forced distribution. So if you ever find yourself in any of these situations and you've recently deposited a 401k check into a non-IRA account, here is rule number 1. Contact a CPA or a tax attorney immediately, and I mean this week. You need a professional who is specifically familiar with Revenue Procedure 2016-47 before that original 60-day window closes permanently. Because I can assure you, the IRS definition of acting promptly is not measured in months.
Rule number 2 applies if you are preparing for a job transition or retirement right now. Bypass your local bank entirely for this. Call your plan administrator directly and explicitly demand a direct rollover in your very first sentence. Ask them point blank, will this check be made payable to me personally? If they say yes, that is an indirect rollover. You need to stop the process immediately and ask again for a direct transfer.
I want to leave you with the exact wealth-saving advice that David received from his financial planner in the very first 2 minutes of their phone call. Quote, "Do not accept a check made payable to you personally. Request a direct rollover only. Have the plan administrator send the funds directly to the receiving IRA custodian." Those 3 sentences saved David $59,000. So as we wrap up this explainer, I really want you to ask yourself, do you know for certain which procedure was used the last time your retirement moved? Think back to your past job transitions. Did you receive a check in your name or just a confirmation of a transfer? Because as Vincent's dining room table realization perfectly illustrates, the difference between financial security and a devastating tax bill usually comes down to just a few carefully chosen words.
So that is the entire difference. 12 words. A check made payable to you personally instead of to your new IRA custodian. That single detail cost Vincent $59,000 more than his former coworker, from the exact same company in the exact same restructuring. Here is what matters. Right now, someone watching this just got an HR letter with a 60-day deadline sitting on their kitchen table, and they have no idea they are one phone call away from making the same mistake Vincent made. If this video just saved you from that, do not scroll past this part. Hit subscribe right now and turn on notifications, because every week I break down another real situation just like this one, the exact numbers, the exact mistake, and the exact fix in plain English nobody else gives you. And if you are currently sitting on a $401,000 decision from a job change, a retirement, or a family member's passing, go watch the video right on your screen next, where I walk through exactly what to say when you call the plan administrator so you never end up on Vincent's side of this story. Drop your situation in the comments, your age, your state, and whether you know for certain if your last rollover was direct or indirect. I read every single one, and if something looks off, I will tell you. I will see you in the next one.